Treasury hit up against the debt ceiling, and now is maneuvering around using extraordinary measures to prevent a default on our debt. Now, we believe, most people believe, that these extraordinary measures will be good until some point in June. So in June, and as we get towards June, there will be more drama.
Cathie Wood, CEO and CIO of ARK Invest, expresses her concerns on the increasing confusion going on within the Fed policymakers. She acknowledges the surprise of the latest employment report and sets the stage for a discussion of the current state of the economy. In the latest market indicators, the equity market had a positive month with communication services, consumer discretionary and technology-based strategies performing well. On the downside, defensive sectors like utilities and healthcare had negative performance, except the genomics part of the healthcare sector. The energy was also down, which was surprising because there were expectations that a boom in demand would occur after China was off of zero COVID. However, it's believed that China has been building inventories and getting Russian oil at a 40% discount to the market price. Chairman Powell has, however, confirmed that the Fed is not in a 1970s-style inflation spiral, which was the reason for their actions last year. The employment report supports this notion as the strong growth seen in recent times not resulting in higher inflation. The Phillips curve, which suggests that employment and inflation are positively correlated, may no longer hold. Thus, the Phillips curve, which came back into style under Chairman Powell, may be going out of style again. With the Federal Reserve's recent interest rate increase, Wood believes that the bond market sees a lower outlook for growth and inflation and hints at the possibility that the Fed may be softening its stance. As she dives deeper into the subject, Wood sheds light on the sudden growth of the Fed funds rate and highlights the rarity of such an increase in the past. She also sheds light on the recent shift in the tone of the Fed's advisors and the growing concern that the Fed may have gone too far in their tightening efforts. In this video, Wood quickly runs through the fiscal policy, monetary policy, and employment report, which she believes is falsified and doesn't reflect the actual reality of the economy and the surprising change of tone of the Fed advisors. As you watch the video, please ensure you hit the like button, subscribe, and turn on notifications.
A couple of other things happened in the last week to give us the sense that Chairman Powell is getting a little more uncomfortable with the Fed's position. One is that two advisors, or we believe that these individuals advise the Fed, who used to be on the warpath against inflation, have changed their tune a bit. Not that they think letting inflation go is what we should do. But I think they're becoming a bit fearful that that Fed policy might have gone too far after really encouraging the Fed to tighten up. One is Janet Yellen, who is the current Treasury Secretary. And you'll remember the word transitory. She had used transitory as inflation was picking up. And then in quite a dramatic moment, she apologized for using the word transitory, said she was mistaken. This was sometime last year, and really almost encouraged the Fed to act as aggressively as possible. And that's when we started getting the sense that 75 basis points was going to be the norm, not the exception. Well, she's changed her tune, and in this last week, she said something like, once we're through this inflation and we've got it under control, and we seem to be doing that, we're probably going to be facing an environment where inflation and growth are very, very low and problematic for businesses. Another person who has changed his tune fairly dramatically is Larry Summers, who was a former Treasury Secretary. And he was cheering the Fed on last year as it was hiking rates 75 basis points at a time. And he was saying, no, we're going to have to go to 6, 7, 8% to get this inflation under control. And now he's saying, whoa. Ahead of the Fed meeting, he said, don't suggest what you're going to do next. Let's sort of wait and see. Of course, the Fed did go up 25 basis points, and I think that's because it had primed us to expect 25 basis points. But now he's got two advisors who I think were very influential last year, who are basically saying, wait a minute. In fact, after today's employment report, which we'll get into in a minute, Larry Summers said, whoa, 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 whoa. I actually think that businesses are going to feel like Wile E. Coyote. They're still hiring like crazy as activity is falling. So, they may be looking over the cliff. So, again, very, very interesting. And then the other, I think, most important point coming out of the Q&A after the FOMC decision, so the Federal Open Market Committee decision to raise rates 25 basis points, was Chairman Powell's answer to the question, do you believe we're in a wage price spiral? Lyle Brainerd, another Fed member, does not believe that. And Chairman Powell said, I agree with Lyle Brainerd. Now, that was a very big admission that we are not in a 70s style inflation, which is what they were fighting last year. Again, today, the employment report corroborated this notion that we're not in a wage price spiral.
Wood reviews the employment report and points out how much disparity exists between the report and the actual reality. The January employment report showed unexpected results with 517,000 new jobs added, which was higher than the expected 260,000. The unemployment rate dropped to 3.4%, a level not seen since 1969. The average weekly hours worked increased by 0.3 hours, which is rare. The average hourly earnings increased by 0.3%, which puts the year-over-year wage inflation at 4.4%. However, this does not align with other economic indicators, such as the Challenger job layoff rate, which increased by 400%. Many companies, including Amazon, Alphabet, and Microsoft, have reported weak sales and earnings. The growth of social commerce through apps like Instagram and TikTok is also becoming a challenge for Amazon. Wood is skeptical of the employment report, as it doesn't seem to match up with other economic indicators, and the income growth might not be sustainable. We will now see in the video what she had to say about this.
Income is probably, in the month of January, up in 1 month's time, up roughly, it's somewhere between 1.5% and 2%. That's just a sequential increase. So that's, 15% plus at an annualized rate. So that's a boom. It doesn't square with what we're seeing out there elsewhere. We're seeing the Challenger job layoff rate up 400% plus in the month of January. We are hearing, the headlines are screaming layoffs. Listening to earnings reports over these last few weeks, one layoff announced after another, or hiring freezes at best. We're seeing the banks take reserves for bad debt. Big increases, like billions, $1.5 billion, I think, for JP Morgan. There were a number of billion-dollar increases. Just in the last few days, we saw reports from Amazon and Alphabet, Meta, Apple, Microsoft, and all of them were showing serious weakness. Advertising is one of the most discretionary of expenses. That actually started weakening dramatically nearly a year ago. And as you know, we believe we were in a recession last year. And sure, we've gotten a bit of a reprieve. But if you look at what happened in the fourth quarter, the GDP statistics, we did get those the preliminaries. Inventory accumulation accelerated in the fourth quarter. And we thought that retailers were discounting so heavily because they were trying to clear shelves. Well, consumption, if you look at the retail sales reports, consumption looked terrible. Now, services bolstered consumption in the GDP reports, but goods consumption was very weak. So, what we're seeing from this employment report does not square with reality.
In other news, Cathie Wood believes that new technologies such as AI and blockchain will have a profound impact on the economy and increase productivity. She anticipates a $14 trillion market by 2030, driven by a four-fold increase in productivity and a 25-fold increase in the value of crypto assets. She also predicts a strong future for Bitcoin, with their base case for 2030 at almost $700,000 and the bull case at double that. What do you make of Cathie Wood's insight into the employment report and the present economic status? Let us know your opinions in the comment section. Also, make sure to leave a like, subscribe, and turn on notifications. Thanks for watching.